Welcome to Key Points for June. Now this month, our take on the encouraging signs coming out of the reopening of economies, our take on what seems to be a bit of a mindset shift at the European Union, and why it's still liquidity that is a primary driver of risk assets. Now, turning to our first point, the opening of economies is beginning to take place on a gradual basis following the severe lockdowns as a result of COVID-19. And indeed, the duration and the pace of this reopening is pretty much in line with our expectations and our base case scenarios. It's encouraging to see some of the very early data for the end of April and May show that there is some recovery taking place. For example, the purchasing managers indicators that you'll know that we look at, whether it's manufacturing or services, have indeed ticked higher. We're looking at some of the sentiment indicators on business and consumer side, which again is looking a little bit better as well. And even the beleaguered US labour market in terms of continuing jobless claims is looking less bad than had been expected. Now let's be clear, the levels are still truly horrific, but the fact that we appear to be past the nadir is certainly encouraging and something that we had been indeed expecting and looking for. Now this takes us to our second point, because although these levels are still very bad, we are still seeing support coming both from the central banks and on the fiscal front. And indeed, on the fiscal side, the European Union, the European Commission actually has surprised positively with quite a significant recovery fund that is being now debated, about 750 billion euros, made up largely of grants, but also some loans. And indeed, this is the first real sign that there is now a potential acceptance of a mutualization of debt, something that we felt was long overdue and something that was really required if indeed Europe was to have a profound challenge to some of these economic slowdowns and cycles that we're likely to see. So still very early days, but again, the mindset at least seems to be moving in the right direction. Now turning to our third point, as I said, the central bank are continuing to provide liquidity. We're seeing in the region of $6 trillion of asset purchases coming across globally. It's moving up towards 7 or even potentially 8. And that is leading this rally that we're seeing. Certainly the fundamentals for equities or credit are not great, but the liquidity is driving investors towards these asset classes somewhat reluctantly. And indeed, when we look at the credit markets themselves, there's been a huge amount of issuance in the last few months. In other words, companies seem to be still taking advantage of the openness of these markets, and they're almost pre-funding their needs going forward. As a result of that, we think this is likely to abate somewhat, and that's going to lead the demand side, we think, to produce or push credit spreads lower. But also this same fundamental is likely to lead to equity prices to move higher. But again, this is based on liquidity rather than fundamentals. Consequently, we have to take this with some degree of caution. We are also still facing the challenges between the politics between China and the United States, creating volatility. But broadly speaking, certainly in the near term, we think this liquidity can drive markets further. Remember, this full report, along with all our other papers and topical thoughts, can be read on zurich.com/MSME.